Investment strategy. Too far, too fast for equities? After hitting their year-to-date lows in late March, risk assets have put up a formidable rally over the last month. The three signposts we were watching for in April were peaking of infection rates, risk of virus resurgence, and stimulus from policymakers. The first and third signposts played major roles in driving investor optimism over this rally. Containment measures in major economies are taking effect, and, as anticipated, we're starting to see infection rates peak in the US and Europe. In addition, G7 policymakers have successively fired stimulus bazookas over the last few weeks. Importantly, the second signpost we've been watching for, the risk of subsequent waves of outbreaks, continues to make us uneasy. Despite a concerted effort to resume economic normality for a few months now, the path towards resumption in China appears to be long drawn out. Economic activity remains below average, even in the domestic service sectors, which have been less affected by weak export and manufacturing demand. Uncertainties still remain. In the absence of a vaccine, we believe that the process of exiting containment measures globally is fraught with uncertainties, and the risk of a more drawn-out recession, longer than 12 months, needs to be watched carefully. The widely held baseline expectation is that the global COVID-19 recession will be short-lived. But we are wary that the bear case of an extended recession longer than a year could lead to significant market downside ahead. The bottom line: we're cognizant that the flattening of the virus curves in the G7 economies and the focus of policymakers moving on to exiting containment measures, plus an unprecedented degree of fiscal and monetary stimulus in the backdrop, is potentially a potent setup for market upside ahead. Given where valuations are and the risks in play, however, we believe a balanced stance is optimal at this point.